Hello, everybody. Thanks for joining us today. So what we're going to do is we're going to talk about our latest blog post. You can find our blog at www.ttvaluetalk.com. I'd encourage you to subscribe to that. It's a really good newsletter. We put it out weekly, and it provides great information on current market conditions, relevant information. It has research reports, all of that sort of stuff. So definitely subscribe to that. Subscribe to our YouTube channel if you haven't already. So we're going to talk today about the market valuations of a few companies. I think we're seeing some real signs that the large cap tech sector is in a bit of a bubble. Huge rallies on some of those names. Really, the artificial intelligence revolution has really got people's blood boiling, and so they're bidding the stocks up to really stratospheric valuation. So we're going to talk about that and kind of relate it to history a bit. So let's go ahead. Let's get started. Just the initial disclosure: investing involves risk. Options aren't suitable for everybody. Past performance is not indicative of future results, and this is for educational purposes only. So back when the tech bubble burst in the early 2000s, the CEO of one of those tech darlings that saw a meteoric rise and a calamitous fall was Scott McNealy, Sun Microsystems. And so he had a great shareholder letter, and in it he wrote, "At 10 times revenue, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you paid no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at 64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking?" So it's a poignant letter, and it really points to the fact that when people are buying stocks, they're buying it for so many different reasons. A lot of people aren't performing that fundamental analysis to really see, okay, what is this business actually worth? And keep that in mind. Every stock is just a fractional share of a business. Many times people are buying stocks because, they have to, they're part of the index. So you got to keep that market cap weighted, for instance. So the larger the stock becomes, the more some of these indexes have to buy. Another reason why people buy stocks is that sometimes on a glamour stock like this, sometimes it's keeping up with the Joneses. So, your neighbor is making a ton of money in Nvidia, and, you're just so stupid for not buying it too. Look, they're buying a new Tesla and you can't do it because you didn't, speculate in the stock. And, it works great for a while, and then, reality sets in. And so what we're going to do is we're going to talk about Nvidia, and we're also going to talk about another stock that's been in the spotlight and that's trading at one of its higher valuations in a very long time, and see if perhaps history will repeat like it did kind of in the tech bubble, and even as recently as last year when a lot of these tech stocks collapsed. So when we look at Nvidia, on May 18th, the stock closed at $316.78. The book value was $8.96 per share. Now, book value is not usually highly relevant for a tech stock, but it does just provide perspective. I mean, you can compare it versus the same stock at other times in history. So the price to book's 35.3. The dividend yield is 0.05%. The enterprise value, which is the market cap plus debt minus cash, that over the sales ratio is 29x, so it's trading at 29 times sales. Very rich. Remember that quote from the Sun Microsystems CEO was based on 10 times sales. So we're at almost 3 times that. The forward PE ratio is 69.2. Remember, this is a growth stock, so looking at the forward PE, there's a very rapid growth rate implied in that. So the forward earnings yield, which is the inverse of the price to earnings ratio, basically it tells you if the stock paid 100% of its earnings as a dividend to you, what the yield would be. It's a paltry 1.4%. Remember, the 10 years at about 3.7% right now. So huge discount to the 10-year bond rate. The trailing 12-month price to earnings ratio is 180. So the trailing 12-month earnings yield is about 0.5%. So very, very, very expensive stock. And, it's the market cap is well over $700 billion. So, I'm not aware of any large cap stocks like that have performed well for a long time at this valuation at over 25 times sales. I'm sure there's smaller caps that have, because they have more room to grow into it. Doesn't mean that Nvidia is not a great company, or that their products aren't great, or that their future's not super bright. It is. It is very likely, but I would just say that there's no margin of safety at the current price. Now, that doesn't mean I would suggest shorting it. I've made that mistake in the past. I did it with Tesla. Tesla had similar metrics to this. This was going into it was early 2020, I believe, actually, and the valuation was so extreme. The stock was out of control going up, and I made the mistake of making some bets against it, and it was costly, because just like John Maynard Keynes says, the market can stay irrational longer than you can stay solvent. And so, I'm not, so, I mean, if you did want to bet against it, the way to do it might be, bear put spreads or something like that. We could talk about that in another video, but I'm not suggesting that. I'm just saying there's no margin of safety at the current price. So let's go ahead and let's go to our next stock. So another stock that has been in the headlines for all the right reasons with their Chat GPT product that everyone is so encaptured with. So yes, on May 18th, Microsoft closed at $318.52. Book value, $26.18 per share, 12.2 times book is what the stock's trading at. The dividend yield is 0.86% for Microsoft. The enterprise value to sales is 11.3. So once again, we're well over that 10x on the Sun. And we're talking about a massive multi-trillion-dollar market capitalization company here. And now their cloud-based business is growing rapidly. And they've done just a fabulous job. I remember the stock trading at 12 times earnings about 8 years ago, 9 years ago, 10 years ago, roughly. And during that time, first of all, they had Steve Ballmer, who, sorry for any Steve Ballmer fans, but he was an atrocious CEO as far as capital allocation. He made so many bad acquisitions, just terrible. But they did do a good job under the leadership of Satya Nadella. They did a great job of converting their Word, their Office platforms into the cloud. I mean, we still use all the same products, but cloud-based, subscription-based, instead of just a one-off, software purchase. And then, of course, them and Amazon are the two leading players in the cloud system, with their Azure product. Amazon's got the Amazon Web Service. So as companies are needing ever more data, and they're basically, renting that data space from Microsoft and from Amazon. And it's a nice business. It's a good margin business, but it's just also massive. And it's just a huge growth platform. Almost every company is having to shift towards the cloud. Every large company is having to shift towards the cloud in one way or the other. So forward PE is 30. Okay, so remember I was talking about how back in the day, a decade ago, we were buying it at 12 times trailing earnings. So the forward earnings yield, which once again is the inverse to the PE, is 3.32%. The trailing 12-month PE is 34.4, and the trailing 12-month earnings yield is 2.9%. So, Microsoft, the business is firing really well. People love the fact that that's relatively recession resistant. Great balance sheet, great margins, good growth trajectory, but I would argue that it's priced in. And so I would argue that the margin of safety is a lot less now than when you could buy it, a few years back at 22, 23 times earnings, just a few years ago. This is an atypical valuation for Microsoft. So, that's just what I wanted to show. I just wanted to show that the market seems a little inflated. A lot of these stocks have rallied a long way to start the year. Rates are still high. They've gone up so much, so there's a lot of competitive things that you could buy with your money. And I think you want to be careful here with some of these glamour stocks. So really, that concludes the presentation. If you're looking for more information on our firm, you can find it at our website, www.ttvalueinvesting.com. And we manage accounts for folks. We're a financial advisor. And please subscribe to our video channel. We're trying to grow it, and so we can put out more content like this. Thanks so much. Have a great day. Bye-bye.